Yeah, so great. How's everyone enjoying the conference? It's a good time. Yeah. Excellent. Well, we're going to jump right into it. I'm going to have everyone introduce themselves because we really have an all-star panel here, and we have a lot of exciting things to talk about. I actually wanted to kick it off with a slide. Not sure if you saw this, but this was published in Crowdfund Insider. There you go. And it shows the potential of the small cap IPO. And the reason why I wanted to just kind of kick off this panel showing this slide, because this slide really illustrates the promise of the small cap IPO. And this slide should serve as a constant reminder of the potential, of the significance, and the power of the small cap IPO. If you look at it, I mean, we're talking about here just a handful of small cap companies when they went public, now worth of $1.6 trillion in current market value. Currently, they have over 890,000 jobs, employees, and if you just look at the market capitalization and growth, it's just tremendous, the amount of wealth that these companies have created over the years and for the small investor. And that's really, when it comes down to it, this is why we're all here today. It's all about democratizing wealth, it's about creating jobs, and it's about fueling innovation. And I think we've really finally reached a pivotal point in the crowd finance industry, where we're now seeing companies in all stages of development starting to leverage crowdfunding with great success. So as I said, we've got a great blend of panelists here today who can truly demonstrate the promise of modern finance. So I thought we would begin by we'll go one by one, everyone introducing themselves, their backgrounds, their businesses, and then we could jump into talking about how various companies are leveraging crowdfunding, what's working, what's not working, what more could we do to engage the crowd and galvanize micro investors. You want to start, Ken?
Thank you, Daniel, for the introduction. Hi, everyone. I'm Kendrick Nguyen, CEO of Republic.co, which is a Title III equity crowdfunding platform. We're a sister company of AngelList, and so we borrow, what we have seen in Silicon Valley, and hopefully make that more accessible for investors and entrepreneurs alike. So really excited to be here and share our perspective and experience in what we have seen in the past year. I think it's been a moderately successful year for the industry, and I'm even more excited about the industry today than I was a year ago.
Hi, everyone. Michael Hughes. I'm the Senior Director of Equity Crowdfunding at Indiegogo. Indiegogo pioneered crowdfunding when we launched in 2008, so we've been at this for quite a bit on the perks rewards-based side of crowdfunding, and our equity crowdfunding platform that services Title III and Reg A and all of this new stuff launched in November last year. So we're now doing both. So excited to be here.
My name is Brian MacMahon. I am the CEO of Expert Dojo. We're an accelerator in Santa Monica, based on top of the Santa Monica Mall. We bring about 500 companies a year through our initial program, which is more of training and education and advancement, and then we bring a number of companies then into our venture studio, and now we're bringing more companies into our accelerator itself. And equity crowdfunding, rewards-based crowdfunding, we've been working that for 3-4 years, doing multiple programs with Indiegogo especially. We've never done a Kickstarter, not a plug for any particular reason other than these guys rock. And equity crowdfunding, this year, it seems that every single startup we're working with is looking at equity crowdfunding to replace the fact that seed investment through institutional investors is at a crazy high figure. So it's become a necessity.
Great. Hi, I'm Yali, Harari, and I'm an Israeli entrepreneur. Today, the CEO and co-founder of a company called Innovesta.co, which is a crowd diligence platform. As we see the market growing and becoming a standard for investments, we felt that there's a need to look at the due diligence process differently and more responsibly, and connect collective wisdom into the process before everybody decides to invest or not to invest. Happy to be here.
Hi, I'm Bill. Is that working?
Is it? Can you hear? Yep.
It is? Okay. Bill Rouhana, Chairman and CEO of Chicken Soup for the Soul and also Chicken Soup for the Soul Entertainment.
Okay, you switch, yeah.
Hello.
Better,
That I can
better.
hear. Hi, let me try it again. I'm Bill Rouhana, Chairman and CEO of Chicken Soup for the Soul and Chicken Soup for the Soul Entertainment, which just went public through a Regulation A+ transaction about 3 weeks ago. So that's why I'm here. Chicken Soup for the Soul, as you may know, is best known for books, but we also have our own line of pet food, believe it or not. We have a digital platform that we share with Ashton Kutcher called aplus.com, and now we have our Chicken Soup for the Soul Entertainment division, which makes television series and is building a direct-to-consumer online video business. So that's what we do.
Excellent. Well, welcome, everyone. I thought that maybe, Michael, we would start with you. I mean, Indiegogo really helped birth the crowdfunding industry, as you all know, and ever since has been really setting some new precedents in the space. Can you discuss a little bit about how Indiegogo's early success in rewards-based really enabled it to offer significant value to equity investors, and how you made the transition into the equity side?
Yeah, sure. First of all, I can't take any credit because I'm not the co-founder, but our 3 co-founders, Slava, Danae, and Eric, are all still with Indiegogo, which is pretty rare in the Valley. I always like to start with the original idea for Indiegogo when we launched in 2008 was actually to enable investment from the crowd. That kind of sounds familiar now that we're at this crowd investing conference, right? But in 2008, that was pretty revolutionary, and it wasn't called crowdfunding, it wasn't called any of this, none of this existed. But the laws didn't exist in the US, as you've heard the last couple days. So we had to actually invent a way to do it legally. So this perks, rewards-based, what is known as crowdfunding, actually exists because we had to kind of invent a way to do it. Stumbled into a pretty good business there, but now have 10 years of experience. We've done hundreds of thousands of perks, rewards campaigns. Millions of people have backed a campaign on Indiegogo. And we've heard throughout the years, wouldn't it be cool if I could invest in these companies? Wouldn't it be cool if I could come to Indiegogo and, maybe not be able to raise seed funding like Brian said and get my crowd and my fans and my community to invest? So we're leveraging that experience, and it's going quite well. It's not for everyone, but what's nice is we have both options, and you can kind of, depending on what stage you're at, it might be a good fit for you, both the perks or the equity side.
Well, and actually, maybe Ken and Brian, you could talk a little bit about, having worked with a lot of early stage companies and coaching entrepreneurs and helping them obtain angel investments. I mean, how do you guys view crowdfunding, as a mechanism for finance?
So we're talking about equity-based crowdfunding, because it's really funny. Rewards actually goes hand in hand with equities-based crowdfunding many times. Because we have so many startups come through our program, because we have a very large investor festival where we bring a lot of investors through, we're continually being asked by startups, what's our best way to get 50,000, 100,000, 200,000? And generally our first response always is, sell something. Right? So unless it's an app and you're looking for users and you want something else, but definitely if it's a product, definitely if it's something that people will buy, will be try and see if we can do a rewards-based crowdfunding campaign. Because if we can do that, then we prove concept and we prove that people actually want what we have. And then you can go on after that, and once people can see what you've got and the traction you're working with, now you're actually on a basis of truth with investors. And I think if I just pointed out, when I first came to Santa Monica, I had a multitude of different companies. I arrived here at the beginning, and what kind of horrified me was the fact that there was such a high failure rate within an early stage startup. I mean, like 97, 98%. As an Irish guy, I often say I wouldn't go to a bar with a 97% chance of not getting a beer. So I just didn't get why nobody was really focusing on the fact that business development is possibly the biggest issue, that it's not done early enough. So rewards-based crowdfunding and in what's more recently equity-based crowdfunding has absolutely replaced, in many cases, what used to be angel funding or seed funding at $200,000, which is now seed funding at about $2 million. Do you want to add anything to that, Ken?
I do. I mean, equity crowdfunding has a very unique value that Title II, that is venture financing, does not, and reward crowdfunding also doesn't offer. And that's this unique value, branding, customer loyalty, marketing. It's irreplaceable. When you buy a product, it doesn't matter if it's on Indiegogo or Macy or eBay, you're buying a product. If I'm a $50 investor in Sky Vodka, that's all I'm going to be ordering from now on. It doesn't matter if Absolute is exactly the same. So I think that unique marketing value really does encourage, and we have seen companies that could easily do reward crowdfunding, and they've been backed by venture, nonetheless have gone through the effort to fundraise on Republic, and that value converted users for them get, in a way that I think is truly unprecedented, and we're going to see a lot more of that realized over the next in the coming years.
I agree, and it's great for early stage pre-revenue companies to really get that opportunity, get the brand out there. But let's kind of switch gears a little bit and go to a company like Chicken Soup for the Soul Entertainment, which is a brand that people know and love. It's been around for a while. And it's also already not only generating revenue, but profitable. And, here you chose to use a crowd finance mechanism, Reg A Plus IPO. So I thought maybe we could kind of talk a little bit. First, I want to say congratulations, by the way. For those of you who don't know, Chicken Soup went public last month. It is the largest Reg A Plus IPO to date. The company raised $30 million, $120 million pre-money valuation. First to list on go public through NASDAQ Global. Tremendous success story. So congratulations on that. It's really exciting.
Thank you.
And I think what's important is that for people to know that your IPO truly exemplifies, I think, what the modern small cap IPO should look like. Those companies that we saw on that slide earlier. And one of the things that I read a lot in some of the press, because I've been following you since the beginning, was one of the articles talked about how you were able to marry the crowd with institutions very successfully to complete the offering. Can you talk about how Reg A Plus enabled you to do that?
Yes, I can, actually, since we just spent a month or two trying to figure out how to make that work. And it worked a little. I'll tell you why we did a Reg A Plus deal to begin with, because obviously we could have done a regular way IPO under what's called an S1. But it seemed to us that it was very chicken soupy to do a Reg A Plus type deal, because it allowed individuals to have an equal shot at owning the stock as compared to institutions, which, on Wall Street isn't always the case. When a deal is really good, the institutions get it, and the individuals tend not to get it. When a deal is not so good, the individuals get their shares. So we were sort of hoping we could find a way to marry access to for individuals, our fans in particular. We have 2.8 million Facebook fans. We sell millions of books every year. We have 1 billion content views of our content every month on the internet between video and articles. So we have a very large fan base, so we thought it would be wonderful to allow them to participate as potential shareholders in our new entertainment business. And the idea was to use the crowd side of the financing to make that happen. But on the other hand, I did not want to bring in shareholders into a company that didn't have an active trading market after the deal was over. And I was afraid that you would be selling a public offering, but not really have a public stock when you were done. Mm-hmm. You'd have a private stock, but with a public filing. And so we wanted to marry Wall Street and a robust selling group with the crowd in order to try and get the best of both worlds. That was the theory of it. It sort of worked. Not entirely, but sort of.
So, that kind of also leads me to my next question, and I think, when you sort of brought that up, when you talked about, the crowd and engaging both the retail investors, I participate in a number of these events, and, and I'm curious also, especially the guys that really focus on angel investing. In a lot of these events, I hear that there's a lot of discussion about how will angel investors, venture capitalists, look at cap tables where for issuers that have gone out and raised doing crowdfunding rounds, early, even Reg CF or early kind of crowdfunding rounds. And, there was always been discussion saying that venture capitalists will look at these cap tables full of all of these investors, and it would actually be a turnoff. And no one really talks about what I think is so important, which is this concept of diversification in cap tables and having the benefits of having all of these retail investors in a cap table. And it kind of just as it is for your portfolio, when you're investing, to have all different exposure to all different stocks or asset classes. If you're an issuer and you have, let's say, a cap table with a lot of investors, and you have, Joe retail investor sells 100 shares of your stock to go pay for a root canal, it's not going to impact your stock. But if Fidelity goes and decides that it wants to liquidate its position to move on to the next shiny object, that has a significant consequence to the issuer. I mean, it could the stock could completely tank on that. So, I think that this is an important thing that we should all talk about, actually, the benefits of having, crowd-based cap table. And I would love to get all of your input on that as well.
I'll start because I have the mic, I guess. But I have two thoughts. So going back to what a lot of the panelists were saying, I think there's a big misconception out there for whether Title III or Reg A. And what I love about what Chicken Soup for the Soul is this isn't only a way, like, equity crowdfunding is not for companies that can't raise money. Okay? It's for the best companies, in my mind, and I'm sure Ken probably agrees with me, are like, great team. We're just like other investors. We look for great team. We look for some sort of traction. We want, if you're profitable, that's the best possible company, right? Like, we want profitable companies. They're not all profitable, but that would be great if they were. And the other thing is, like, equity crowdfunding, to me, a Reg CF or even a Reg A can augment a fundraise from institutional investors. That's another thing I get over and over. People don't understand. It's not mutually exclusive. So we've done deals, I'm sure Ken has done deals where we had one deal, Play Impossible, that was being led by a VC. They were raising about $1.5 million. They already had half of that committed from a prominent hardware VC in the Valley. And they said, hey, wouldn't it be cool if we opened up a piece of this round to our fans, to our community, to our customers, and use this, like Brian said, a lot of it, and Indiegogo has 10 years of this, it's not only raising money. It's like you said, these are people that are going to be your biggest cheerleaders. They're going to tell everyone they know. And guess what? They're truly passionate about your business. Why wouldn't you let them and say, wouldn't it be cool to, hey, you could invest right alongside Joe VC. And guess what? Joe VC doesn't always know what he's talking about either, just FYI. So.
That's true too. And Brian, I'd like to get your opinion on that, especially because I watched your TED Talk the other day. First of all, I loved it. It was really inspiring. And I think you perfectly in that talk capture the injustice in the venture capital market. And I think your exact quote was, you went so far as to describe it as a pyramid scheme where the public pays ultimately.
Yeah, I don't always go to the pyramid scheme. Sometimes I go to the Ponzi scheme.
Right, okay.
I do. I kind of jump from one to the other. So look, inherently the current system for how money is raised as a technology company is incredibly unfair. And it's actually unfair to the investors as well. But what's happened is the entrepreneur have become the ones that generally lose out more often than not. Most entrepreneurs will get fired from their own company if they get institutional investment, at least 60%. The companies that do get institutional investment, the vast majority of them find it extremely difficult to make it to a liquidity event. And the people that you're working with are really accountants who are just looking at you being one horse of 20. Now, to make it worse, the majority of people are pushed out of being able to get into the process of working with angels or VCs because the angels or VCs will work with their people. And this is not meant with any disrespect to institutional investors. We work with them all the time. But the system at the moment is rigged. And it's not a good system for anyone. The returns are too small for everyone. And I think this is also why we used to see seed investments at about $200,000, maybe $500,000. Now we don't see that. Now a seed investment is $2 million because the investors don't trust the startups and they don't trust the system. The valuations are being pushed up. The people who should be the great entrepreneurs get pushed out by other entrepreneurs. So like, and this is no disrespect to Amazon, but like Amazon had $6 billion pumped into them over a 10-year period before they even started looking to make money. So are they really the pinnacle of the greatest company that we have in the United States? You know, I would point to a company like Chicken Soup for the Soul that really makes the point on building a community, building a market, doing it, I don't want to say the old-fashioned way, but the right way. So when you go to an equity crowdfunding campaign, you really bring in the shareholders that you want, and you kind of build this Harley-Davidson way of being where they're never going to buy a Honda. Like once they buy your bike, you got them forever if you can get them into that system as well. So I really like equity crowdfunding for that. I totally agree with what Michael says. Is a lot of people go for equity crowdfunding thinking, this is cool, I can't find an investor, so I'm going to go and there's loads of investors in this channel. And here's what in reality happens. You go on the platform and you're a bit like an empty restaurant. You've done a little bit of research, you've probably paid a couple of overpriced consultants, you've gone in, you've bought some BS list, which is of very little use to you, you've agreed a payment that you're going to make of $20,000 or $30,000 on marketing, you put on the platform, you do, and then look into the mind of the investor, the person who's then looking on that platform. They see a pitch from a person who's some random Joe who's going, hey, my business is cool and it's going to be worth $1 billion, which is aligned with accounting, which is from the same person saying, just in case you didn't see my pitch, here's what this says, which is with a video which says exactly the same thing. And then we expect them to invest money in the company. I'll just give my final conclusion, which is where I think this is going to go. Equity crowdfunding is an awesome beginning because it allows the crowd, the people who will buy our product, to actually take control of the entire process of which companies become rich or wealthy and do well or don't do well. I don't think the angel investors or the venture capitalists are that relevant because we will create new angels from everybody in the United States and all over the world who've got 401ks who can invest their money in. But I do think we're going to need to combine it with face-to-face, bringing the band on the road again. So we're going to have to bring those startups to St. Louis and Ohio and Vegas and all those other places so that those investors are able to touch them. And then we'll move to just a way better world where our companies are actually reflected by the people who are going to buy the product.
And I think you're right. I mean, we have to galvanize this great. So, Yali, for you, because it's important that we go out there and we galvanize the crowd. It's important that we let them understand that this market exists, as the opportunities exist from an investment standpoint. But I think you play a tremendous role. I love what your platform is doing because you're actually providing the mechanism for due diligence to let the investors understand what because a lot of people don't know. And right. I really do. I think that retail brokers, I think, are dinosaurs. I think that that's the old way. That's never coming back. So a lot more of this is do-it-yourself. A lot more is technology. So how does your platform help some of those investors?
So thank you for what you said. I couldn't agree more. I think the crowd equity funding markets, not just in the U.S., but we work also in the U.K. and it's starting in Israel somewhat, is really getting to the next level. But what we're missing, you called it face-to-face, what we decided to build is a platform that allows for a real serious due diligence with the entrepreneur, with the investors, with the relevant crowd that might invest or not invest at the end, but they are experts in that specific field. The knowledge is out there. It's not one person or a team of analysts in a VC that knows it all, and it's not just the data on the internet that's not really in the context of the startup. So the ability to take the platforms and really include some rankings, some formal due diligence, crowd diligence we call it at Innovesta, which brings together the entrepreneur, the investors. We all have to be at the same page. We're all going through this journey together. So there's not that, the entrepreneur comes in, the investor looks at them, yes, no, and the whole game. This is history. The new way of doing it is really putting everybody virtually around the same table, having conversations. Some of those people may end up being, non-accredited investors and passionate about it, and some are just innovation lovers, and they're experts in specific startups without really having the money to invest, or being the McKinsey, banker or McKinsey consultants. So I think adding to those platforms the ability to have, so it's not a second option to go to a platform. It's actually the realistic, responsible option, because it will include some different ways of doing due diligence. We might be part of it, and I'm sure there are other methods of how to do due diligence, but it doesn't have to be not serious because it's on an equity platform.
If I may add one thing, so at Republic, we definitely have funded some companies that could not get money anywhere else, and we're really proud of it. I'll give you one concrete example. One of the companies we funded for was a single mom Latina from a poor, farming town called Fresno. She spent most of her life at Lucky working in corporate HR. She has a phenomenal idea. She has tested out here and there. Certainly doesn't have a family network in order to fundraise $50,000 or $80,000 to do it. She is not appealing to VC, even impact VC, because of her background, and she's also not 22. So we launched a campaign for her, and she raised $80,000, more than $80,000, primarily from Latino American professionals and their friends. And we can see the messages beyond it. So I think crowdfunding also does engage people to be much more involved socially, and it's not just return on investment. We, of course, also do think that she's such a rock star, but with traits that may be biased against in the traditional lens. And we have, obviously, other companies that have been venture-backed. But I do think that crowdfunding does work well for a whole host of entrepreneurs who currently are completely outside of the financing economy.
Yeah, totally agree. I just wanted to add two quick stats, I think. So Indiegogo on our perks experience and like 10 years of data that we have. So I think we've talked about diversity a lot, and it's really inspiring, and I'm really proud to work for a company that we actually have real data that, like, so this is a true stat, don't quote me on this exact number, but it's more than 50% of the successful perks crowdfunding campaigns on Indiegogo were by women. Okay? That's not because we're holier than thou and we say women and this and that. We believe in everyone should have an opportunity, but the women are just doing a better job at it, like was said yesterday, and the men are doing great too. But and then the other side I wanted to share, this is why really equity crowdfunding I think really is the future, is that look at the UK. Yala mentioned it. Like, people, we're talking about the US right now. Type in UK equity crowdfunding, okay, when you leave here. There's multiple platforms doing hundreds of millions of dollars a year, and they're 5 to 6 years ahead of us in the US, because in the US, we tend to be behind in this stuff. ICOs, we're always behind, right? So, this is already happening. This isn't like something new that's like, oh my God, this couldn't possibly work. And it's for everyone and all types of companies that couldn't possibly, restaurants and just like people that wouldn't even get on the radar of a VC.
Well, I think it's interesting too. I don't think that I think that we are looking at a whole new path of capital formation, and I don't even think even with reward base that reward base is just for these small companies. You have an idea on a napkin. I mean, Bill, maybe you could even provide some input. I mean, here Chicken Soup for the Soul Entertainment, well capitalized company, but could you ever envision a way that maybe you, like a company like yours, could even go and use a reward based reward-based platform?
Actually, we've been thinking about doing that. I was going to talk to that.
Call me.
There. I was going to talk to you. Yeah, you were the one. Yeah, we should. But I think if we do something like that, we'll end up trying to make sure we facilitate the creation of some capital for some charities. So for us, for us to take that step, we are a for-profit business. We make a lot of money. If we're going to crowdfund, we're going to crowdfund for some social reason, not just for a profit reason. And we'll try to drive something that we think is important and try to use it that way. I mean, it'd be very hard-pressed for us to go out and raise capital to do a project out of the crowd, because the crowd doesn't get anything back except a gift of some sort, or unless we give them a piece of it, in which case we sold the security, and I think we have to register. So, we have thought about this, though, and in every single time we've thought about it, the context has come around to, let's see if we can create some money for some organization that really and truly could use it and put it to good use. And let's use our brand and our relationships with our fans to try and make something important happen.
See, corporations with conscience.
And I'll give one more example from Indiegogo, or just one quick thing. Is another misconception is that under like a Title III Reg CF campaign, and Ken knows as well, you can offer perks and rewards. Okay, so someone can't come to a Title III Reg CF campaign and just claim the perk, but they can invest. And then what you do as the issuers, you're using the perks to incentivize people to invest at a higher level, right? So hey, put in $500, you get X amount of equity. Put in $1,000, you'll get X amount of equity and the product at a discount, and a face-to-face with Ashton Kutcher, probably more than $1,000, right? But, and then one more example. So we're already doing this on Indiegogo with giant corporations. Yep. We have an entire part of the business called enterprise crowdfunding now, which is a new term, but it all started with a little company called GE. So GE came to us, and they have this whole thing in Louisville, Kentucky called First Build. It's a really long story. You can go look it up, but long story short, that is the arm of GE that is creating new products, new hardware products. They are now using Indiegogo and have done it multiple times to do market validation, as Brian said, to do testing. What does the crowd want? Can we prove it? They don't need the money. The money doesn't hurt, but it's more like, holy crap, we had this ice maker. Go look up Opal Nugget Ice Maker. Okay, it's Nugget Ice apparently is really popular in the South. I'm from New England, so I don't know, but thousands of people bought this thing. Thousands. They raised like $1.5 million, I don't even know, more than that, for our Nugget Ice Maker. And then there they go. They're like, okay, we just saved millions of dollars in time and effort. We already know the crowd wants it, and boom, it's cheaper, it's faster, it's a more efficient way. Crowdfunding is market validation and exposure and marketing, and then it's fundraising.
Can I just add, I just want to add one thing to this. I'm kind of continually the Debbie Downer, but it's only because I hate failure. Like, I despise it. I don't even want to learn from it. I just want us to be successful straight away. And the only way we can do that is to milestone and track towards it. Be really careful. If you do either an equity-based crowdfunding campaign or a rewards-based crowdfunding campaign, I swear to you, it will either be A, the hardest work you have ever done in your life, because you're taking a 12-month marketing campaign and you're cramming it into a 2.5 to 3 month pre-campaign, or you will do a shitty job on getting the results. All of those people, like I've seen some great, there was a great one recently which was Goodnight Stories for Rebel Girls. They came out with a book, which was a phenomenal book, which is great female icons, which they put in the book. They've raised about $700,000 or $800,000, but they had such a robust campaign. Yeah, which was an Indiegogo, of course, but they had such a robust campaign that they spent a lot of money on digital marketing. We have 3 campaigns in Expert Dojo that are launching on Indiegogo in the next 25 days. One campaign for Nessa Brush Spa, which is like an automated makeup brush cleaner, so it's a cool product, first of all. We have over 100 influencers on day one committed to posting at least 4 times. You know how much work she had to do to get 100 influencers? Virtually impossible. And then she's got, how many people would you say of her closest friends who have committed to buying one on the first day? Just give me a number. 500. 500 people. Her mom is prospecting for her. Her dad is threatening with breaking people's legs if they don't buy her automated makeup brush cleaner. Like, that's what this is. This is more than just validation of my product and it's okay. This is validation if you have what it takes to make it right at the beginning. Because making 5,000, 10, 15, I respect anything that people do, but this is your chance. It's your business. So you better believe it'll be the hardest thing you've ever done in your life if you do it properly, and take it really, really seriously. And a lot of the ones that you see and you hear about, just be very careful. None of them are what you actually think they were, if that makes sense.
The big successes don't happen by mistake. Yeah. I'll just leave it at that. That there's a lot of planning that goes into those, 99% of them. There's 1% that go viral. Everyone else, there's a ton of planning and potentially a bunch of money spent to raise millions of dollars. So just keep that in mind. It's a lot of work, but you're right. It shows the grit of the entrepreneur, of the person as well, which I think is really interesting.
Well, I don't think anyone would disagree that we are truly looking at, a whole new system for finance. I mean, we are looking, I think we're looking, technology and the regs, I think it's changing everything. It's changing the way we lend, the way we borrow, the way we raise capital, the way we invest, the way we do due diligence. Our currency. It's changing everything. I think we're just looking at a whole modern world for finance. And I know that everyone, especially at this event today, last 2 days, we've been talking a lot about ICOs, cryptocurrency is like the new buzzword in this space. And I thought, Ken, maybe you could kind of talk a little bit, but more about how coin offerings are really kind of completing the whole crowdfunding, equity crowdfunding universe.
Yeah, sure. And I'm sure a lot has been spoken about the past 2 days. My main two observations are this. One is that ICOs it's not just a frenzy, it's here to stay. And right now is by and large illegal or not in full compliance with the laws in any country for that matter. You can't really overlook something when, AngelList's platform on ICO is called coinlist.co. They just closed around the very first one. It's a pre-seed company that closed over $200 million. That's something that's unheard of in my world. And so we're right in the mix, and Republic will have a play in this whole thing in the future. But I do think that it's so effective in that it gives a lot more people skin in the game. So with normal crowdfunding, you're just gonna go out and you evangelize, and that's so unique and powerful. But with a typical blockchain ecosystem, it's gonna encourage you to participate so that your own token will rise in value. So it does complete this feeding circle of the crowd now having skin in the game to promote it. So I think its use case in the long run is gonna be vast. It's gonna reach even the restaurants, the clubs in LA, and go well beyond blockchain protocols.
It's a fascinating space. I also want to touch upon a little bit of a topic, too, that's really been bothering me lately. Bill, as you know, your IPO, I really think there's just so much historical significance behind it, and I've been following it closely and have been quite vocal about how recently I wrote an article in Crowdfund Insider that talked about this attack that we're actually seeing on the small cap IPO. And I think this is really something that everyone here should really be concerned about and have their eyes open to, because what we're seeing now is we're seeing a lot of manipulators out there that are trying to really hurt the whole small cap industry for all of us. They're trying to manipulate the situation, and they see that small cap companies are going public, and they are thinly traded, and it's really an opportunity for them to get some fake news out there and to just try and use abusive shorting to knock the stock down, not to do anything. I mean, it has nothing to do with fundamentals. Fundamentals are completely solid. This is all about lining their own pockets. I mean, this is, I think, a problem that we as an industry really have to voice, because if we don't see the rebirth of the small cap IPO of yesteryear, I mean, this is going to be a significant economic problem in our country. So, we're talking about bringing the crowd back in. Let's talk a little bit about how we could solve that. And maybe, Bill, you could talk about a little bit about the experience, and we could talk about what we could do to bring, to galvanize the crowd and see what we could do here.
So Dara wants me to share my last couple of weeks of personal pain with you, which I guess I will do. We went public, I think it was the 18th of August, maybe it was something like that. And since that time, our stock has gone from $12 to $7.70. What has happened? Absolutely nothing bad. In fact, business is good. It's excellent. But what happened the very first day we went public was machine trading short sellers attacked the stock and had it down 25% by the end of the first day of trading. It was fascinating, but there were a series of problems that exist today in the trading world that allowed that to happen. The first of which was there was no prior day closing price. Why does that matter? It matters because on NASDAQ, you can short only on an uptick once a stock is down 10% from the prior day closing price. But if it's your first day of trading, you have no prior day closing price, so that rule does not go into effect. So their stock can be shorted all well beyond 10% without anybody having to have an uptick. So that is a really ripe opportunity for abuse. How do people protect against that usually? Generally, in a regular IPO, you sell what's called an underwriter over allotment. And that is more shares are sold to the underwriter than are actually issued to the public, so that the underwriter has capital to stabilize the stock as it starts to find its sea legs, let's call it. But it turns out, in Regulation A+, you really cannot do that yet, because Regulation A+ deals close in the opposite way of regular transactions. Money goes into escrow first, shares get issued later. And so there's no mechanism to sell more shares and hold on to the money. That's a problem, because the lack of stabilization is what attracts the short sellers to begin with. That is exacerbated by the lack of an uptick rule. So the combination of those two things are very, very difficult for small companies the first couple of days they're public. And once a negative trend sets in, human psychology being what it is, it's very tough to reverse it. And so we're watching our stock go through the same process that 3 or 4 other companies have gone through as they've tried to go public using this approach. And they've all been hit by short sellers and very dramatically negatively affected. Now, if that doesn't change, it's going to be very tough for CEOs to actually want to do this. It's not fun to have your stock go down. It's not fun to have it go down immediately, and it's not fun to have it go down for no reason. And if you feel a responsibility to shareholders, which obviously some of us do, I certainly do, it's very difficult to watch that happen to people who just put their money up, even though the company has done nothing wrong and it continues to do what it's supposed to do, and we'll fix it over time. The fundamentals will take care of it. But it is a very bad way to start something like this, and it's very discouraging, I think. And I think it will be discouraging for other people who are thinking about using Regulation A+ as a way of going public until those structural problems are fixed. There are a couple of others, but those are probably the biggest and most important, I think, right now. So they really do need to be addressed. I think somebody has to take a look at these and try to come up with good ways to stop this vulnerability. Because there are people who like to make money on shorting stock. I mean, that's okay. They're entitled to have an opinion, but they shouldn't have a structural advantage. That's not really what that's supposed to be about.
And I think also it's, that goes back to Yali, and what you're doing is really, we have to bring the crowd into the space. So what more do you think we could do to actually bring even the crowd not only into the offerings, but into the aftermarket?
I think once we establish communities of experts, and we call them opinion leaders, people who know the market, understand what's going on, and we combine them in the whole process, first of all, the engagement with the company continues, and they can continue and invest or restart to invest wherever they were, but really have the collective wisdom share what's going on and not just be, I am an investor or not an investor. I think we're minimizing, or we're still not exploring the full potential of the community of the people, and I think it should go not just from early stage due diligence, where it's more ideation and product thinking, but really into the whole process. It's not structural, but I think that's the mechanism that has to be developed.
Yep. And Bill, you want to add to that?
Yeah, I don't mean to hog the microphone, but I do think there's something interesting you all should know. When we were going public, we had about 76,000 people try to buy our stock. Now, if you just think about that number, that is an extraordinarily large number of people. We advertised a very small amount of time on social media to try and bring in the crowd, let's call it. 76,000 people came and tried to buy our stock. 905 people got through. There is definitely a need for somebody who can actually help people go from interested to acquiring in the business place. And the biggest problem was the know your customer rules that brokerage firms must abide by caused every single person to spend at least 45 minutes trying to actually buy a share of stock. And people don't have the tolerance for that. That's just too long. So that was a problem. Now, I will tell you, I am considering the idea of advertising again, because I'm not sure that we can't. But now that our stock is on a market and can be purchased quite easily by anybody in different brokerage firms, I think it might be interesting to see if we can engage the crowd already being public,
Right.
in order to fight back against this, this phenomenon we're seeing, and I'm thinking about it. We've been innovating all the way along this process. It's been a very fascinating process using Regulation A plus the way we did for the first time to create do the largest offering ever, and to really go straight to the NASDAQ global market. NASDAQ is trying to be supportive, very interested in us being successful, and I'm trying to think about ways we can continue to innovate even in the aftermarket and use our fan base and deploy our fan base to help fight back. Because if we don't have an over-allotment option, we do have a fan base, and it's still there, and it's still very strong. So we're going to try and use it, and maybe all of you, to fight back against these people.
So I think we're going to have some time for some Q&A, but before we do that, I thought we would go down the line, and I thought it would be great if each one of you would share your best tip or your best piece of advice, one for today's issuers, one for modern investors. So just real quick, what would be your one best tip or piece of advice?
Make sure that you are mentally ready and have like bandwidth in terms of like time to do it. I think someone said that you're cramming a 12-month effort into it. If you're going to put in twice the work compared to normal fundraising, I think you're going to get twice the value out of it. So that's for issuers. Modern investor, I think that there's no one who shouldn't be an investor. Think of investing $10, $20 at a time. That's a new way to engage socially, not just about return on investment. Invest in that, I don't know, refugee founder or women founder, whatever cause that speak to you, small amount over time, and you're going to acquire and become more savvy with time.
Micro-investing is powerful. I mean, the technology is making that possible today, that people, for the first time, small investors have the opportunity to be truly diversified and customize their portfolios. Never had that ability before.
And you can even invest through credit card on Republic, so there's no reason not to.
And on Indiegogo, but. For issuers, I think I would say the same thing. I think we get a lot of people that come to us that it just sounds sexy or cool, I want to do it, but they're not in fundraising mode, right? You'll know what fundraising mode is when you're in it. Trust me, like you're ready to fundraise. You have a pitch deck. You have your financials in order. You know your numbers. Just like you were going to go pitch a VC, you should be in the same mode. And if you're not there, you're not ready now. You might be ready in the future, but you're not ready now. For the investor, I would say do your homework. Not only on the offerings on our different sites, but on the sites themselves, and look at a lot of the deals that are presented and try to evaluate sort of the quality level and what you're getting into. And there's a lot of diligence that goes on and varied levels of diligence that goes on some different platforms. And I worry that a lot of investors are just thinking, it's up on a platform, it must be a good deal. Not necessarily the case.
That's why you need a platform like Yali.
That's why we need Yali, exactly.
A couple of small, quick little tips, and then one big one. Firstly, don't give voting rights, obviously, because it's just a nightmare. Secondly, be aware that the crowd, the community can be a powerful ally. It can be an awful nightmare at the same time. If you have, it'll be your granny. It'll be your granny who put $50 into your company who'll be calling you up, asking you why you didn't hit your financial figures, not the big company. So you just make sure you are staffed up and ready and prepared to deal with the community. Sometimes it's like that Jagger song, right? You get what you need. So, but then the big thing is, don't look at this as the biggest mistake by far that we see with all entrepreneurs trying to come through us or elsewhere is they look at this as an event. You got to think of a crowdfunding campaign as a marriage. Like it's just merely one day in whatever amount of years that you're going to stay married. You don't just plan the event and then you finish it and you congratulate yourself and you're ready. This particular lady who's doing Nesta Brush Spa, she has her crowdfunding event launching in 2 weeks' time. She already has, $100,000 guaranteed on it, looking to hit $500,000. She already has QVC lined up for the beginning of January to take the money that she's going to get out of the crowdfunding campaign to use as the prepaid money that she's going to need for her 90-day payment terms for QVC, and she's lining up Shark Tank for March next year. And it's all tied into one long-term plan which goes to the milestone she wants to achieve as a company.
So for the issuer, lines with everybody here, just really know what you want to do. Don't just jump for it because you read a great story or you see the publications or it sounds like what you need to do. Really figure it out before you jump into this. There are many ways today to raise money, and you have to really look at the long term, as you mentioned. And for modern investors, I think it's our responsibility as global citizens today to invest. I think we need to support innovation. We need to support women because those platforms allow that. And I think you really need to look at the deal and feel connected to it, feel connected to the entrepreneur, not just if it's a good video, but really get to know the ecosystem. Because once you become connected, it's going to be a great journey for everybody.
I don't have that much to add. I think you guys did a great job. Obviously, before anybody invests in anything, they should really take it seriously. It's not, it's not playing. This is a serious thing to invest in a company. And I will tell you, one of the most interesting things about having gone around and raised money under the Regulation A+ banner was the number of times people said to me, well, those individuals, they don't know what they're doing. When they give you money, they're going to not have any idea what they're doing. And I found that sort of contemptuous, frankly, of individual investors, and maybe sometimes true, but certainly not from my perspective something that one should assume is the case when it comes to people who are not not professional investors. Some of the smartest people I know who have invested are not professional investors, and they've made some of the greatest money. Quite often, the professional investors are best at following each other and doing the same thing as each other's. Whereas, that's a good. You can clap. That's a good thing. This is individuals sometimes have the greatest insights into what will work in the world because it's what they need. And I don't think it's right to assume that they are not capable investors. I think it's quite the opposite. But of course, they have to take it seriously. It's not, it's not a joke. It's real. So.
That's great. I think we're getting the sign now, but that was fantastic, guys. Really appreciate it. Thanks. We ended it at the perfect note. That was perfect. Power of the crowd. Yeah.